work with IMC, which is one of the world's largest electronic market making firms, and we have about 600 people worldwide. I'm also the chairman of the FIA EPTA, European Principal Traders Association, which is a group consisting of 24 member firms, and you can assume that probably 1 out of every 3 trades on the European exchanges will have our members as one of the, on either one of those trades, so it's quite a substantial one. In derivative markets it will be a higher number than that. The question here is market structure and technology, who benefits? Well, it's very interesting because I think that our main thesis is that the market participants don't benefit, actually, because it makes markets more efficient, i.e. less beneficial for the less beneficial for the intermediaries. But as a result, it's more beneficial for end users. So pension funds and, for example, retail investors. And I will show you a little bit of data to back that up. Now, some of this data, see there's different sorts of opinion about whether it's the right time scale to look at, but it's probably roughly correct. And firstly, how do I do this?
You need to turn it on first. Maybe it's that on the side. You can put it on.
Yeah, this should
no,
work.
I mean on the side of it. If it's on, then otherwise.
Yeah, it's okay.
Okay, it's working.
It worked. So looking at institutional commissions in Europe, I used to run trading at Goldman Sachs. In Europe, we were charging clients in 2000 around 25 to 40 basis points, so 0.25 to 0.4 basis points to transact their trades. Were all done over the phone. We call it high-touch business. And today markets have changed significantly. We estimate 60, 70, sometimes 80% of the business is done through algorithmic direct market access at rates as low as 1 to 3 basis points for execution-only business. Huge savings for end users. This is just commissions, which is the explicit cost of trading. So this is what the actual end users pay. They don't pay exchange fees. Brokers are the ones that pay exchange fees. Second one is, where do I point this at?
The guy at the back.
The guy. Here we go. This is an Observa report. Again, it also shows somewhat similar numbers over a much shorter time period, over a 3-year time period. The commissions paid by the end users in their sample went from 11 basis points to 8.8 basis points. So you see a similar number. So this is the actual cost paid by the end users. And then this is not the only cost that end users suffer from transacting in the market. A more important one is actual market impact, you call it execution shortfall, or some people call it transaction cost. And there's a few firms that collect this data for the largest and the numerous institutions all over the world. So this data is based on millions and millions of transactions done. And what is the market impact that these trades have generated? So that's the additional cost on top of the commissions that are paid. And ITG, which is a firm that works for these institutional investors, shows that this has, since 2003, both the US and Europe, these costs have declined consistently. Another one is Elkins McSherry. They collect this data as well for institutions. Another one is Abel Nozer. They all show the same thing. So our thesis is that these markets have never been better for the end users to trade on. There is more liquidity, and I'll show that in a second, and it's cheaper for them, which is not necessarily great for the intermediaries. I think there's always a debate about, I think earlier it was mentioned, what are institutions actually thinking about high frequency trading? I think that definitely we recognize that there are skeptics. And I think definitely we recognize there are skeptics. And at the same time we're saying, well, we're bringing so much to them. But I want to also balance that a bit by showing you some examples of very large institutions that actually think differently, that actually do believe that high frequency trading on a net basis has benefited them. And these are some of the largest institutions in the world. I'm sure where I'm supposed to point. So, you know, the likes of BlackRock has published research on it. They think it provides a vital service. Vanguard, these are not insubstantial asset managers. I think that the lion's share of high frequency trading works to the benefit. JP Morgan Asset Management believes that their ability to trade stocks for clients has actually considerably improved. Wellington believes as well as on a net basis, the Managed Fund Association. So these are not insubstantial asset managers and associations. We recognize there's asset managers that think differently, but to say that the opinion of the asset management industry is this is an incorrect statement. Liquidity, there was just a bit of a discussion on it. Liquidity is not the size that people can sell on the bid-ask. No, it's actually a measure of what does it cost me to transfer an asset into cash. It's different from volume. Volume is how much is traded in the market, so it's the amount of trades done versus the share price, times the share price. Liquidity actually has to do with how much depth there is in the order book. And technology, again, has brought huge improvements to this. So this is a figure, the Xetra liquidity measure that's published by the Deutsche Börse, which shows that in some cases, liquidity has improved by 3 times. This is just, by the way, Deutsche Börse. This is not taking into account, you now have other venues that you can transact your shares in as well. Direct result of lower barriers to entry, more participants, and better technology. Next one shows this, the same for the FTSE, and it shows the same for the CAC, which I think we just spoke about. Arguably, the size on the bid and offer is less because tick sizes have gone wider, but the actual depth of the order book very clearly shows that there is more liquidity, i.e. it's cheaper to transact even in larger size as a result of technology. I always like to show a good example. The Tokyo Stock Exchange has published this, where they show that when they went to a new system called Arrowhead, they went from a slow exchange to a much faster exchange, and their liquidity in the order book 3 months before the adoption of that system to 3 months after the adoption of that system went up by between 51% and 139%. So any attempt to slow exchanges down by a minimum order resting time or something like that will result in these arrows going in the reverse direction. I'll show you an example of a market where it has financial transaction tax, like 12 basis points. India. India is a great example of a market where it has a very old and slow exchange system. It has a 12 basis points transaction tax on all participants, and as a result there is no high frequency trading or participants in that market. So a very small order of $125 million order, which is relatively small, entered for an institutional investor by a broker, by mistake, causes a 16% price drop, precisely because there are no high frequency traders in that market, because of transaction taxes in this case. So I think there's also an example of severe dislocations that can happen. And if we go back one slide, again the Tokyo Stock Exchange showed this in this was on 9th of August, which was the first day after the US credit rating downgrade. This was a period of very severe turbulence in the market, very big, as we call, market dislocation. On the left hand you see the end users, the non-co-located clients, and where the net selling pressure was coming from. And then on the right hand you see the co-located clients, so what they define as high frequency trading clients. So if you actually overlay these graphs, the selling pressure was effectively coming from the end users, exactly what you would expect. And the selling spikes were met by buying spikes of the high-frequency trading participants. Now, Eurex has a chart, which I haven't included, which shows identical information for another volatile day, which was also called the flash crash, which shows that the high-frequency trading participants are actually there to provide liquidity in times of very high volatility. There is a study from the University of Sydney, to which I think the FSA cooperated, and I think Tim may be able to, which shows exactly the same information around very volatile periods in the UK market. So there's a lot of data to back up that these firms actually provide very useful liquidity when they get the chance around times of very high volatility. Then I want to just go to the last page. So what do we think of MiFID? Obviously, we believe in safe markets. So we've seen big errors happen in the market. We've seen that in India now. We've had a flash crash. We've had, you know, a variety of different technology-related errors, which have been very much publicized. I think that what we should focus on is trying to make sure that the markets are safe from that perspective. So we support resilient and safe markets. We've actually published a lot of studies and recommendations to that effect, which you can find on our website. We promote risk management, because we believe as well it makes markets safer. So anything that makes technology development safer, that forces people to do better testing, forces people to put on the right risk controls, both exchanges and all other market participants, we applaud. Anything that tries to artificially slow markets down and will ultimately then increase the cost to the end users, we're very skeptical of. So, you know, proposals like the minimum order resting time, which we've spoken about, and I think that you understand our views on that, or order cancellation charges, I think will harm liquidity and harm all the good things that have been achieved over the last 5 or 10 years. So, I think that's the end.
Thank you.
Thank you.